The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
This is Don Creech.
And this is Perry Sykes, and welcome everyone to the Investor Resources Podcast. Today we're going to talk a little bit about modern portfolio theory, which was developed in the 1950s. Nothing modern about it, by Mr. Harry Markowitz here. It's used by so many portfolios and retirement funds. At this point, most people have probably heard of it, but might not understand exactly how it works. But it is the foundation for many of the portfolios out there. So we're going to discuss the basic premises of modern portfolio theory, a lot of the conventional implementation, and what are some of the shortcomings, because there are quite a few, more than most people think.
Well, some of those shortcomings have actually caused financial advisors to rename this the mythological portfolio theory because of the lack of real academic research on performance.
And that's a big issue. And one of the biggest concepts inside of MPT is market efficiency, meaning that it's essentially impossible to beat the market as consistently, because as information becomes public, everybody gets all the information all the time, and it leads to the conclusion that the market is always fairly priced. And so the best time to purchase securities is, of course, miracle of miracles, always now. And you always hear the common theme: stocks always go up in the long run, so why not buy now? And once you hear that, if you think about it, that's when you should realize it's 90% sales pitch, and there's not a whole lot of data backing it up, like you said, Don.
Well, the efficient market theory assumes that every price in the market on every day is the correct price. Well, it is a correct price as far as buyers and sellers on that day are concerned, but it does not allow for the fact that, as you just put on the screen, fear and greed actually drive investor emotions. So that when we go back and look at the tech bubble in the first quarter of 2000, all those overpriced stocks were efficiently priced, and anybody who was buying them had all the information necessary to make a wise choice, regardless of the fact that we had a 3-year bear market afterwards.
Right. So where everyone's supposed to believe that was rational, that made sense, and that everyone acting as a rational investor decided that all the pricing in the market, which the day before was 100% accurate, is now almost completely wrong. And we're going to have a massive sell-off. And that's one of the problems. You know, people are very emotional. Fear and greed drive the market more than any two forces out there. And those inputs are not in modern portfolio theory. There's no way to account for those. And so one of the two largest drivers of what moves the market around aren't even included. So to believe everyone acts rationally all the time really doesn't make any sense. And the next thing is trends. Markets tend to trend, and market efficiency would say that can't be true, but it is. And that's why you have things like asset bubbles, like the tech bubble you were just talking about, Don, where prices are completely unreasonable. If the market was 100% efficient all the time, that sort of thing would never happen. It couldn't, because the markets would already have that priced in, and it would already be efficiently reflected in the price of everything. It's funny how it doesn't happen that way, though.
This is one of the conundrums that academics have had in trying to backtest or create a replication of trend following or momentum-based models. When investors get caught up in hype, if you will, and recently we've had the AI hype, it didn't last as long as the hype leading up to Y2K. I mean, that was a 3-year hype, stimulated by government intervention, mandating every company that was regulated and every financial advisor, all of whom are regulated, had to prove that their computers would not crash on January 1 of 2000. Well, that turned out to be a myth itself. The DOS still worked. on the first day of January 2000, but we had a massive bubble because government didn't understand technology itself. And we've had a recent bubble in AI. The real application there is in broader industries, not just the handful of tech stocks that are promoting their new product, but it's when people get on this bandwagon that you just referred to that creates a trend. Some of them persist, and more recently, with all of the headlines that we have on the economy, those trends have not persisted for, well, the last year and a half, basically, a little over that.
Correct.
They
Yep.
start and they fail quickly. And that's just the irrationality of the market. It kind of denies the efficiency argument, if you will.
Correct. It doesn't make sense that a company could fundamentally change that drastically that quickly. So it is just irrational behavior, which should not exist in an efficient market, which is required for MPT to actually continue to work. And this is the problem where people don't want you to worry about anything. They just want you to go ahead and, buy what we're selling you and don't worry about anything else. Don't check anything. Don't worry about the prices. Don't worry about anything. Just understand that now is always a good time to buy. Trust me, we're gonna sell this to you today. It's gonna work out great. And that really is the rationale behind so many brokerage firms. Sell it quickly. Most importantly, sell it to someone today. And MPT helps them do that. It's just a marketing tool.
Well, and marketing is what makes money for the advisors, the advisor business.
That's it.
And that's actually, as we were doing this, we just watched the IPO on ARM, which is a British company, and the big headline was IPOs are back. Wall Street made millions in this IPO offering. But what
Right.
typically happens with IPOs is they get the hype, they suck in a lot of investors, and then the guys who've been in the company for some time start selling shares at extended prices. And over the next 6 months, is my general rule, you get closer to the real value. And
Find out where you are. Yeah.
and ARM, as an example, the executives kept a lot of shares back, hoping that it would go even higher and for them to sell. But even at these prices, it wouldn't surprise me to see some liquidations over the next several months as the hype kind of expires.
It's true, and it's usually right around this point where people start saying they start talking about advisors, just like you said, just on they start talking about, well, money managers wouldn't really use this if it wasn't going to help them outperform the market for extended periods of time. One of the most famous arguments for that was made by the book A Random Walk Down Wall Street, which just said just pick a few stocks. It really doesn't matter. The market will take care of you. You don't have to worry about which stocks you're buying. Just buy some and hang on, and everything will be fine. Which it's absolutely inaccurate, but that's what helps the advisor to get in there and sell you something. And there's a lot of disadvantages for fund managers, especially when they get large, if they're trying to outperform the market. But if you look at people like Peter Lynch and Warren Buffett, where they have done that, we've seen it happen. Um, and those strategies often look very, very familiar to each other after the fact. But the key here is just don't fall for the psychological pitfalls that most investors do. Don't believe what Wall Street is selling. In other words, they're trying to tell you there's no reason to play this game. Just send us your money and trust us. And that really is their pitch. And we'll keep you out of the way. And what they're really saying is give us your money, and there is no reason for you to ever take it away. You should never sell anything, but now's a great time to buy. And that's and modern portfolio theory, that pie chart asset allocation is what helps them put a fine point on that argument that you know what you should do because no one knows what's going to happen. Just buy a little bit of everything and forget about it. But make sure when you forget about it, your money's in my firm. And that's all they're really concerned with.
And that long-term hold has an interesting attraction. But the fact is, investors aren't long-term investors. Almost
Correct.
everybody that comes in the door says, I am because I'm not going to retire for so many years. And even when I do, I expect to live decades beyond. but next 6 months or a year out, and there's a little bit of a drop in the value of the portfolio, all of a sudden, you know, I,
Right.
I'm really concerned about what's going on right here. I know I'm long term, but, and there's some reality to the but. When you turn around and look at long term, and I mentioned the tech bubble in 2000,
Yeah.
2.5 years, 2 3/4 years actually, was a bear market. Well, the most long term investors, by the end of nearly 3 years of losing money, had changed their perspective, and they didn't want
They
to
were
be
done.
long
Yeah.
term anymore, and they didn't believe that staying in would recover, and it did. I mean, the tech bubble did. The Nasdaq took 13 years, I believe, to recover to its
To cycle
2000
back up.
high. The
Yep.
S&P took about 7, and the 2008-9 great financial crisis and the housing bubble, when that collapsed, bottom was March 9 of '09, and it took about 7.5 years to get back to even. And during those periods of time, long term doesn't look attractive. And I had a call this week, and an individual said, "Well, small cap stocks are cheap. Shouldn't I just buy those and hang on forever?" Well, that's an option as a buy and hold investor, but value stocks have been in a valley for periods as long as 20 years. The bear market in the 70s basically had some significant rallies, which were called bull markets, but they lasted very short periods of time. And from the late 60s to the early 80s was almost a 20-year period where peak to peak there was no real gain. If you were long-term investor, you had to hold your breath underwater a lot of the time. And particularly as you deal with pre-retirement and retirees, holding their breath waiting for the long term to work out is not an attractive option.
Especially that long. People don't have that kind of patience or that kind of stomach for having losses that large in their portfolios. And the more people buy into that efficient market hypothesis and just buy securities with no thought of anything about it, especially the prices of what they're buying, that makes the market more volatile. People buy and sell things regardless of what's going on. And with all those ups and downs, all the money going in and out, that's why we see so many big runs these days. And everybody gets into one thing, everybody gets out of one thing, and everybody's following whatever the meme is of the day. And it really does cause larger run-ups, quicker crashes, so the market is moving way ahead, and nobody has much conviction in their process anymore. It's all a matter of, well, if everybody's doing it, I'm going to do it, and as soon as they stop, I'm going to stop. And it's such a bad process for people. That's when they buy near the top and sell near the bottom. We see it happen time and time again. People do things at the most inopportune time because they're being driven by emotion and not by any data, which is really what you have to have to make any of this work. And back when this all opened up, prior to modern portfolio theory, the efficient market hypothesis, the only accepted way to improve your returns was to get more risk, to take more risk, and you get bigger returns. And Harry Markowitz, excuse me, did discover that if you diversify into uncorrelated investments, you can get good returns and lower your risk level. And when we talk about uncorrelated assets, we're talking about assets that don't move the same direction at the same time. And a metaphor that we've seen before is a water park and an umbrella stand, because the umbrella stand is going to make most of its money when it's sunny. I mean, when it's raining, and the water park is going to make most of its money when it's sunny. So whether it's raining or sunny, either way, you should be making some money, and that's going to smooth out your income. And that was the idea of working that with asset classes, keep uncorrelated asset classes. Historically speaking, stocks and precious metals didn't move the same way at the same time, or stocks from different countries. So you could get different countries that weren't connected at the hip, and they would get different returns in the stock market, or oil and stocks. And people tried to diversify that way, but the problem is, it worked for a while, but since that theory came out back in the 50s, most market industries, most global stock markets, and even stocks and commodities, the stock market and gold have been moving the same direction and not really helping out investors with the diversification they're seeking. They think it is, but it's not. So all of these different asset classes are becoming much more homogenous. They're becoming just it doesn't matter if you're buying stocks or bonds, it's just another investment, and they may very well be moving all at the same time. So they're really not adding anything as they used to, because they're
Well,
not anywhere near as uncorrelated as they used to be.
that's a point that Harry Markowitz actually made decades later, and that is that his theory was not
Yeah,
really based on broad markets. It was based on individual stocks. And he is on record as saying the financial industry has misapplied his theory. But what you've
correct.
described, Terry, sounds so logical. It makes a great sales presentation, even though the guy that created the theory says it's not the way it's supposed to be applied. But now he makes a lot of money because everybody in financial, not everybody, but virtually the
A
industry
lot.
is
Yeah,
using modern portfolio theory from the 50s. It's kind of like driving your dad's Studebaker and say you've got a modern car. Now, it would be a collectible, but that's really what this should be,
that's
is
as
a
far as it
collectible.
goes. Right. Yep.
And part of the reason the homogeneity that's happened with these assets is because everybody's got the same model. So as a client, you say, this isn't working. I'm going to fire you, Mr. Advisor, and I'm going to go from Edward Jones or to Bear Stearns or to Goldman Sachs or Morgan Stanley or JP Morgan. What you're basically doing is saying, I don't like your modern portfolio theory model. I'm going to go use the other firm's modern portfolio theory model. And they
That's
look
what
at it,
happens. Right.
the broker looks at it and says, well, yeah, you should be in our funds, not their funds. And they give you the same model. It's built on the same assumptions. You didn't get anything different, but you do have a different person to talk to. And the color brochure is going to be a different theme.
And that's one of the problems. And with more and more people going into index funds, and they're being much more passive, that downside uh, um, risk spreading that happens from diversification is not occurring as much anymore, and that's very important to understand. So if you are in an MPT portfolio, which is very passive, you're not gonna do much to try to avoid risk. The active investor is going to have a bigger and bigger advantage when an advisor is actually in control and watching what's going on and saying, you know what, this market makes no sense. We need to do something differently. We don't want to just hold a bunch of things and see if it works or not. Everything's moving together. Stocks and bonds are moving together, and so you're not getting those assets that are picking up when the other ones are falling, unless you're really paying attention to exactly where that's happening and you're willing to make the change. You're willing to make the move and not say, well, historically speaking, I need to keep 10% of my portfolio in emerging markets, say, just because that's what I need. Is it losing money? Yes. Should I be in it? Probably not. But MPT is going to leave you there, which is one of the reasons we've walked away from that at Investor Resources. We are active. We do watch the market, and we change allocations based on the data of the market currently, not what's gone on in the past. And it makes a huge difference for our clients.
You raised the issue of emerging markets, and that brings in my memory back to the summer of 2011. We were
Sure.
on the radio back then. I don't remember which station because we rotated for a while, off and on. But in the summer of 11, we said on the air, this is the time to get out of gold and get out of emerging markets. This is going underneath a major trend change. And both of those took 10 years of declines before they began to find life again. What
Correct.
works in the market is whatever happens to be the magnet that's attracting investor capital. If investors aren't flocking to that particular asset, the price is not going to go up. And that's what everybody wants. They want prices to go up. Broad diversification, as Warren Buffett says, is for investors who don't know what they're doing, because you're
There you go.
basically owning a little bit of everything on the assumption that when you need money, something will be working. And that's what you'll dip into your resources. And the other stuff that still stinks, you're just going to wait longer for it to find out that it's attractive. And if it's not a magnet for investor money, it's just simply going to tread water. And if there are no buyers, it'll just drip lower and lower and lower until the buyers finally arrive again. It is a long-term passive strategy.
And it can be quite painful, but probably something you don't want to, as far as we're concerned, not something that's worth your time to be doing with your money. You have much more important things to do with your capital than try to make Harry Markowitz look better. It's time to move on from that. And that was our look at modern portfolio theory. If you have any other questions about that, we would love to talk to you about it. Feel free to give us a call.
Numbers on the screen. Subscribe to us. You like what we do, subscribe and share. We appreciate your participation with us today. Stay tuned. We'll have another one in a few days.